Hello and welcome back to the RevOps Show. When it comes to customer acquisition and revenue acquisition, is there really a difference between the two? Some of you are probably sitting here thinking there's no way, and some of you are probably sitting here thinking, how do you not see the difference? Well, no matter what side you are leaning on currently, Jess and Doug are going to tackle this question for you right here, right now, on the RevOps Show. So let's get into it.
Jess,
Doug.
you got a smile on your face. I'm so happy.
I do. I have a smile on my face because we're recording this on a Friday.
Oh, I thought it was because you looked at a tool that could maybe make your life a lot easier.
I'm so excited. If that happens, you don't even know. There are no words.
In honor of that excitement, Jess, I have something for you.
What's that?
Baby shark do baby shark do baby shark do baby shark. Mommy shark do.
Thanks for that. Appreciate you.
I love you, Jess.
Yeah, clearly. Oh, what are we doing here?
What are we talking about today, Jess?
I want to talk about customer acquisition versus revenue acquisition.
What's the difference?
Well, that's what I want to talk to you about. Are they the same thing?
So tell me.
Well, I mean, by definition, customer acquisition is acquiring customers, and revenue acquisition is acquiring revenue.
Yeah. So you want me to talk about what the difference is?
Yes.
You want me to make life easier on you?
I do. As I mentioned, it's Friday, and you played the Baby Shark song, so you've killed brain cells of mine.
Cardenas.
Off to a good start.
So one of the mistakes, I don't know if mistake's the right word, but there's a tendency to conflate customer acquisition, winning new customers, with winning revenue. And I mean, there's a good reason for the conflation is, and a lot of times they're one and the same thing.
Right.
But they're actually not the same thing. Right. And so, and in some industries or with some businesses, like some people are listening to this going, what's the difference? And some are listening going to this, how do people think that there's no difference? They're completely different. So for example, we work with a lot of companies that they get a master agreement. They get approved to provide services to, or even in some cases we've seen where they're the exclusive provider for. So we work with a couple of companies that provide a procurement solution, and now everything's supposed to be bought through them through the 726 locations of the company that they just signed. Except when that contract is signed, no actual dollars change hands. So they come back and they say, hey, we just won a $3 million contract, because they analyzed it and said the company spends $3 million and now they're going to buy all of it from us.
Right.
And as anyone who has ever provided one of those services knows, they never buy all of it from you.
Right.
But when that contract is signed, there's no actual revenue. The job then becomes getting adoption, getting compliance, ramping up, getting people to stop buying from who they were buying from, et cetera, et cetera. There are times, we work with a number of tech companies, a number of SaaS companies, where contract is signed, but the revenue doesn't start until, the system's implemented or something like that. And so there can be a significant gap that's there. I mean, we sign an agreement and it says, first payment due on agreement, which, by the way, doesn't always mean that they send us the payment on agreement.
It's true.
Right. And then, there's second payment and, and so, that's the acquiring of revenue. We have our retainer clients. So someone signs up and says, hey, we're going to pay you, let's just say, $15,000, $20,000 a month. We come back, we say, hey, yay, everybody, we just signed, we just won $180,000, $240,000 new customer, except not.
Right.
Except, we haven't actually acquired that revenue.
Yep.
Right? So those are, that's where the obvious difference is. So I mean, I kind of think of it as engagement acquisition,
Mm-hmm.
customer acquisition, revenue acquisition.
Engagement acquisition is interesting.
Right. Well, engagement acquisition is acquiring your attention and your engagement.
Yeah, no,
Right.
totally
Right.
get it. And
Right.
it's so I did some research on this. There's not a lot out there about the difference between the two, and nowhere did I see anybody talk. And not even the concept of engagement acquisition, which is interesting to think about that as its own kind of acquisition lane, if you will.
So we have a pretty short video called "The Science of Growth," or maybe it's "The Science of Scaling Growth" or something, where we talk about, and Jess, you've heard this forever. As a matter of fact, it's the name of our application group, which is Lift. We talk about Lift all the time.
Yep.
I'm a big fan of. I don't understand physics, and luckily I never took physics, but I'm a big fan of the idea of physics. And I'm a huge believer in the principle of lift.
Mm-hmm.
Right. And if you think about it, what enables lift, right? It's what enables flight. Planes fly because of the principle of lift. And basically what it means is that the rate of the velocity of the wind above the wing is greater than the velocity of the wind below the wing. Right. So it's a beautiful illustration if you think about it. And that's where the principle of inbound marketing, that's why the principle of inbound marketing was so powerful, is it really brought the attention to, back then, the top of the funnel.
Yep.
Which was, clearly above the wing. And what I found for a long time was that I would talk about above the wing, below the wing, and people loved the idea of, the metaphor of the principle of lift. But the difficulty is, I don't actually have a plane, and we don't actually have wind. I can't create a wind tunnel. So where is that wind? And what I found was, as I dug deeper to try to answer that question, is the wing is at intent.
Yeah.
So above the wing is before intent.
Mm-hmm.
Below the wing is after intent, right? So customer acquisition, revenue acquisition, obviously, even if it's an impulse purchase, the intent was there by the time you're a customer.
Yes, correct.
Right.
Yeah.
Unless the salesperson signed the contract for the customer, but that opens up a whole nother, that's another episode. We'll call that fraud. And as a matter of fact, I literally just got off a call with one of our clients talking about this. Is, hey, we need to get things moving fast. Right. And so we want to launch this new cold call initiative. We're going to outsource this to appointment setting. And I get it. Like, I totally get it. But what's happening when you do that is you're actually, you're selling against gravity.
Mm-hmm.
And if you think about it, growth is against gravity. Like, you're going against gravity all the time. And so without lift, actually, our friend Mike Donnelly loves it. I haven't said this in a long time. If you don't have lift on your side, the only thing that you have is propulsion. And propulsion is big, explosive, and dangerous.
Yep.
And expensive, right? And it's not sustainable, right? So when you're not generating lift, you're actually increasing the gravitational pull against yourself. Now, maybe you have to do that because, hey, look, I've been there. You know what? I need someone to buy from me in the next 2 months, or, my long-term plan doesn't matter because
right,
I'm not here.
Yeah.
But if you're not thinking about it this way, and if you're not figuring out how to turn that tide, how do we generate engagement at a faster with the type of people that we want to do business with, at a rate faster than we're generating customers? And how do we generate new customers at a rate faster than we're generating revenue? And if you think about it, there's a tendency that a lot of people think all or none. We tend, there's that binary approach.
Mm-hmm.
And so when you take the customer acquisition versus revenue acquisition, you begin to look at customer acquisition through the lens of land, revenue acquisition through the lens of expand.
Right.
And so a lot of times the way to increase growth is to simplify the customer acquisition, right? Once you separate the two, when you think of the customer as the revenue, then the two are tied together and you tie your hands more. When you separate the two, you begin to have more moving parts on the board that enable you to do different things, to approach from different angles, um, and to solve better. I mean, so you gain much more choice without actually increasing the complexity factor or the complication factor by as much as you gain choice. So understanding that those two things are very different is important. Oh, by the way, you land the customer. Okay, that's great. Well, what are you doing next year?
Right. So are you saying that people combine the two too much, and so you're
Mhm.
thinking about it as one strategy versus kind of breaking it into two different strategies?
Yeah.
Um,
So a customer, and I don't mean to, like, I'm going to talk about this in impersonal economic terms, but the reason for it is let's understand the job to be done. A customer is a potential income producing asset.
mhm.
The more potential income producing assets that I have, the more income, the more revenue, or I'd say a potential revenue producing asset, the more opportunities I have to generate revenue. Right. So would you rather have $1 million paying customer or 10 $100,000 paying customers?
Right.
I think people who look at it through the lens of customer acquisition and customer management would say $1 million customer.
Yeah.
That's what you told me the other day.
Yeah.
Right. Because, hey, I only have to manage one. It's easier.
Yeah.
I think looking at it through the lens, and this isn't 100%, there are variations. Like, I want to be clear, this is not binary. But I think if you look at it through the lens of revenue acquisition, you're more likely to say $1 million or 10 $100,000. And I'm talking about that's your whole business, right? I'm not saying of your $1 billion, would you rather have 1 or 10? Well, if I have 10 $100,000 potential producing assets, and let's say half of them run into a problem and they lose half of their revenue production, I have $750,000 of revenue. If I have $1 million producing asset and it loses half of its potential, so you have more risk. There's more that can go. Now, again, there's trade-offs. I don't.
Sure.
My head's going through, like, I'm arguing with myself while I'm talking. Just so you know. But so I look at it, and one of the things that I strive to do with the companies that we work with is, as part of your ideal client profile, that ideal client profile should give you an indication to what the revenue potential is. I think too often companies, they can only rely on what the company is saying, or a small view to know what that potential is. And the reason is they don't know their customer well enough. You should have a good idea. I mean, one of the questions, I'll give you a great story. When I was at Merrill Lynch, big day for every financial advisor was the day that their business owner client sold their business.
Mm-hmm.
And this happened all the time.
Right.
Company sells their business for, $100 million. Advisor comes back afterwards and celebrates, business owner nets $35 million, comes back and says, hey, guess what? My, the owner had a $500,000 IRA with him or something. Hey, guess what? My client just gave me $3 million. I just got a $3 million account, and $1 million account at, in private client at Merrill Lynch at the time. Hey, wow, that was, big, huge.
Right.
Well, at the same time, Bessemer Trust, which positioned themselves against Merrill Lynch as, and I won't, they got $32 million. They got the 32, right? And by the way, the Bessemer Trust rep goes, no, absolutely. Because Bessemer is making their proposal, and that business owner goes, well, I've been working with my advisor for a long time. I really like him.
Yeah.
Oh, no. You should absolutely work with him. Here's the thing. This is once in a lifetime money, right? We're in the business of making sure that you'll never have to worry about that again. So here's what you do. You give us the $30 million. We're taking care of the rest of your life. You go out and spend $1 million on your boat and your new house.
Right.
Give your Maryland, right? And so they hey, guess what? You just won a $3 million account. Yeah, but you lost 30.
Right.
Right. And so I see, and by the way, that plays into, I think most businesses have a tendency to pursue new business, as opposed to how much could they expand within their existing customer base, et cetera. And you're going to be in that play when you don't view revenue acquisition as a separate thing from customer acquisition.
So do you think that's why that is? I was going to ask you about that. Why is it that there seems to be so much focus on customer acquisition and getting new customers over revenue acquisition? Because I hear this talked about all the time with our clients. They always seem focused on that customer piece, not so much on the revenue. Why is that?
Well, I mean, if you go back to the old days of commerce, when I'd walk up to the cash register and I would pay you for something. If you go to the old days of selling tech, you bought, you paid SAP $42 million and you were going to use it for 10 years.
Right.
So I think there used to be less difference. I think, we came from transactional, and today, everyone's in pursuit of recurring. So when you go from transactional to recurring, there's a big shift. But the real reason, I think, is because customer acquisition is an event. Revenue acquisition is an ongoing process.
Yeah, I was going to ask you, do you think some of it's the thrill of the close? Like, I get to ring the bell, I get to say that I closed the account. Like that's exciting. I don't think there's as much excitement around, an expansion opportunity.
So I was going to say that, but by the way, and again, expansion is kind of a subset of revenue acquisition.
Yeah.
And expansion is oftentimes a lot more complicated, but also I was going to say that it was a ring the bell, but then I said, that fits to our story, and how we look at it, because we're very sales focused. But the reality is that the ring the bell is the effect, not the cause. The answer is the customer is acquired or not acquired.
Mm-hmm.
Right. So
I gotcha.
There's a beginning, a middle, and an end. It fits to the way humans think. There's certainty there.
Yeah.
Revenue acquisition is forever. Revenue acquisition never ends.
Well, and if you think about it through the procurement lens of, they say they're going to give us the 3 million that they spend, it's not even so much that it's ongoing as you get that in bits and pieces, and maybe this is ongoing, but you're slowly chipping away at getting realizing all of that revenue. And so I don't think that beginning, middle, and end is as clear as it is to closing a customer.
And most companies, and we're working with companies, $1 billion of revenue, they can't close the loop on that. Right. So the sales rep closes a $2 million account. It's going to come to them through 4 tranches, but only 2 POs ever got executed.
Yeah.
And there's in sales, we live by a mantra: time kills all deals. Well, all revenue acquisition. So when we sign this, and the intent is, we're going to do this, this, and this, things start changing, et cetera, and you're not guaranteed to get those last 3 POs. One of the other elements is, there's a tendency that, hey, we got this account. We see this in professional services all the time. We got this account. It's got huge potential. It's the myth of land and expand, because it's like, okay, we're going to land this account, and we're just going to do great work, and then they're going to do more business with us. Well, A, it doesn't work that way. B, you really didn't position yourself to be successful because you actually overpromised and underpriced. And land to expand is a complex process. And so if you don't have a defined, it doesn't just happen. There has to be a purposeful ongoing element. There has to be, a strategy, and there has to be a program behind that land and expand. And, it's like, why do people pay? You got plenty of people who pay attention to the top of the funnel. You have plenty of people who pay attention to the bottom of the funnel, right? Why does nobody pay attention to the middle of the funnel?
I don't know why.
Because it's really complex. You have limited scenarios at the top. You have limited scenarios at the bottom. You have unlimited scenarios in the middle.
Yeah.
You can't account for everything in the middle, and so it's it's mysterious, and that's that's why I laugh at attribution. First touch, last touch. Yeah, okay, let's do first touch, last touch, because those are easy.
Yeah.
The plumbing's in the middle. But by the way, I can go out and I can win business. I can't go out and expand revenue, right? Acquiring a customer is more tangible. It's more physical. Acquiring revenue is totally intangible. And so people lack the guidance on revenue acquisition. How much should this company be doing?
Yeah.
Right. How do most companies set their goal next year? Hey, I think we could grow 25% next year. Oh, why is that? Right. I mean, so
Yeah.
revenue acquisition, it's hard. Forecast. We had a forecasting conversation, and forecasting new business, not that hard. Forecasting
Mhm.
revenue, hard.
Yeah.
Now, when you get to a certain size, it becomes easier, but that's because you get large numbers. So you're not actually forecasting revenue; you're forecasting revenue outcome.
So what's the difference between those two? Forecasting
Um,
revenue
it's
versus
it's
forecasting
playing
revenue
pool
outcome.
between calling your shots and not calling your shots.
Okay.
So if I have 10 customers,
hmm
my variance is going to be all over the place because if I have 10 million customers,
Right. Okay.
so it's like if I'm Amazon where I'm living on billions of small transactions, you've got the law of large numbers on your side. Your errors are going to be you're going to be wrong to the downside as often as you're wrong to the upside. So in the end, you're much more likely to come out with the right, with the numbers that's the same. But was the path to the number accurate? And more often than not, it's not accurate, right? When I have small numbers, if my path isn't accurate, then my outcome's not accurate.
Yeah. Gotcha. So is there a time where you should focus on customer acquisition? Is there a time where you should focus on revenue acquisition as
Yes.
far as okay. That was easy. Would you like to expand on that? Can you tell me when would you focus on customer acquisition versus revenue acquisition?
All the time.
So you'd always focus on customer acquisition over revenue acquisition.
Oh, you didn't say over.
Oh,
I thought you said and.
I said it in my head.
Oh.
Over.
I thought you said, is there a time you focus on customer acquisition? Is there a time you focus on revenue
I
acquisition?
think that was the first question I asked. Yes, I meant to put an or in there. So is there a time that you should focus on one over the other?
Yes, you should always focus on customer acquisition over revenue acquisition, and you should always focus on revenue acquisition over customer acquisition.
Well, that's super helpful.
Well, it's why this is the RevOps show, because that's kind of a RevOps discipline. There is a, you're looking at it from the top down, from the bottom up,
hmm
and from the side. So I think, again, if I'm not seeing customer growth, or let's use the colloquial term so we sound all sassy and tech-like. If my new logo growth,
oh, there we go,
is running lower than my revenue growth,
hmm
then I'm gonna be then I'm at risk of coming up against the ceiling of my growth. And by the way, if you see a company that consistently has lower new customer growth
hmm
than it has revenue growth, that is definitely an indicator that you're probably going to see revenue growth decline. Now, realize revenue growth declines before revenue declines. People don't understand that. Right? So I'm growing revenue at 20%. Well, now I'm growing revenue at 15%. That's revenue growth decline.
Right, but then your revenue has a delayed drop off of that.
Right. Correct. Yeah. But so what I'm saying, but even before, so if I'm growing at 20% per year and now I have a revenue decline to 15%, then I'm still growing, but my revenue growth rate has gone down.
Right.
Which if that sustains, then
the new revenues.
Right. I'm not, there's a period of so your customer growth rate will proceed. And so remember the decrease so if I'm growing new logos at 50%, and now I'm growing it at 30%. Now, if we're talking from early, we talk about the life cycle of a business. Please note that when you move from one life cycle to the next life cycle, there is a reset. When you go from startup to being a $1 billion company, you're going to see, you're not going to grow new logos at the same rate you grew them when you had, like when I had one customer, when I had my second customer, I grew 100%. Right? So there's a, but again, as you look at that, if I go from, growing new customers at 20% to growing new customers at 10%, I still increase the number of new customers that I got. But if that sustains, then I'm going to have negative customer growth, right? Which means I brought 10 in last year. Now I brought in 9.
Yeah.
Right. Which, by the way, is an increase, right? Because I now have 19 if you have recurring, right? And so there's it's why, it's why people buy high and sell low in the stock market, is because the big numbers don't show up. The big numbers are the result of what happened yesterday, not a result of what's happening tomorrow. So I'm looking at things like what's new customer growth relative to revenue growth. I'm looking at things like when I got to give credit to Dan Sullivan and Strategic Coach. They had a concept they called the largest check. The largest check. Now I have to apply it in different ways to different businesses. Strategic Coach is more geared to like individuals running financial advisory practices and other things. But what was the average of the 5 largest income producing customers over the last 12 months? And one of the things that I found is if your largest check wasn't growing at a faster rate than your average check. So here's how I apply this to a business. If your first quintile accounts aren't growing at a rate faster than your average accounts, then you're coming up against the ceiling. Right. So that's a revenue acquisition element. And the way I tell people, and for those of you that don't know what a quintile account is, quintile is 20%. So what you do is you break. So your top quintile is your top 20% revenue producing customers. First quintile, second quintile. We have 5 quintiles. And what I tell people is your mantra should be, make my first quintile, second quintile.
Yeah.
Right. If I don't see your first quintile becoming your second quintile, then you're coming up against your capabilities. And now the only way you're going to grow is by growing your customer base. And if the only way you're going to grow revenue is by growing your customer base, then your costs are going to increase.
So your revenue is never going to grow.
Well, no, your revenue will grow, but it will only grow at the rate you add new customers.
Okay. Gotcha. Okay.
Right. So I'm bringing in $100,000 customers. So if I have 10 customers at $100,000, I'm $1 million. So if I want to be a $2 million customer, if I want to be a $2 million business and I can't change that $100,000, that means I'm now a $2 million company with 20 customers. Okay.
Well,
why do I want to do that? Unless you're a restaurant, right? which, because if you're doing that, then you need to have, you need to have a very large base of customers, right? You can make a living with one restaurant. And by the way, restaurateurs find this, they go, oh, I'm opening my second restaurant. You know what happens? They work twice as hard.
Yeah.
They make the same amount of money. They get to the 3rd or 5th restaurant, they're working 2 to 3 times as hard. They make less money. It's not until you have 20 restaurants where I'm making $20,000 from 20 restaurants.
Right.
And so, right. So those are the elements that I'm looking at. So if I'm not seeing my customer growth rate, then I'm not building, I'm losing assets to generate revenue. But then am I also increasing what those, what is the revenue yield of those assets? Is that growing as well? Right. When the precursor, right. So customer growth before revenue growth, engagement growth before customer growth, when the precursor is growing at a faster rate, you're raising your ceiling, you're creating lift. Right.
Yep.
When the follow is growing faster than the precursor, then you're going, then you've got a downward pull on the organization that you then have to fight against, which is why companies move from a value creative mindset to a value exploitation mindset. So I always say it's value exploration to value creation to value exploitation, right? So when Starbucks was selling chocolates, and one day they went from selling their chocolates that everybody loved to they decreased the price of their chocolate by 1/3, but cut the size of the chocolate by half. That was value exploitation.
Right. Okay.
When Ajax, and this is a true strategy because it got presented to me as a riddle, this, and this were the case. How do you grow revenue? And it's the stumper for everything. And the answer was make the holes bigger. So one of the ways that Ajax grew revenue was they made the holes in the Ajax canister bigger.
So you were pouring more out when you were pouring
without realizing.
Yeah.
Right. One of the moves that laundry detergent made to concentrate was so that you couldn't make that equation. So you're actually getting less for the money. That's value exploitation, right? That's because you're now in a mature market. It doesn't have customer growth. It doesn't have
Yeah.
your revenue coordinates to that. And so again, that's why, that is the cycle of business: value exploration, value creation, value exploitation. And so those are the numbers that you're looking at. And so there's also the elements of, if I start seeing trends going against my growth rate, that's when I begin to, that's when looking at complementary markets, or I'm sorry, complementary products. It means, maybe there's an adjustment to the market that you're looking at. Those things begin to be, if the goal is to sustain the business, then that's what you have to look at. Though I want to emphasize, the title of the book, of all the books in the history of business books, the title that I like the least, and it surprises people, is the book Built to Last, which, Jim Collins, by the way, the content in Built to Last is intriguing, and there's a lot of good stuff in it. So I'm not slamming the book as much as I'm slamming the title. But my problem with even the content of the book is that it infers that a business is supposed to last. And the example of this is, the buggy whip manufacturer.
I don't know what a buggy. What's a buggy? I don't know what a buggy whip is.
A buggy whip is the whip that you use to whip the horse.
Oh, okay.
The buggy to
All
go
right.
fast.
Okay.
Right. And people say, well, because you weren't paying attention, you thought you were in the make the horse go faster business when you were really in the transportation business. And if you had realized that you were in the transportation business, you would have invented and manufactured the automobile. Except that's so full of crap. I can't even.
Yeah.
Because you tell me what element of capability, knowledge, and core competence somebody who makes a leather whip has to be able to make the Model T, right?
Right.
No, you're in the boutique leather business, and you know what? There comes a point in time where, hey, you know what? Buggy whips aren't supposed to be a thing.
Right.
And so the best thing that you can do is free up your capital, your people, your money, your time, etc., to go do something new. I see I see this happening in small businesses and mid-market businesses all the time, is that, we're built to last. And it's like, well, no one, you'd be better off if you just found that next thing. So again, I'm not telling you that you should leave, but that's the element of why understanding the difference between customer acquisition and revenue acquisition. We talk about opportunity quadrants, right? There's 4 opportunity quadrants, right? High value customers split into low growth potential. We've got all the business they're going to do.
Yep.
High growth potential.
Yep.
Then low value customers split between low growth potential, high growth potential. And so your growth accounts are your high value, high growth, and low value, high growth, or high current value, high growth, low current value, low, right? And so when you begin to segment that is, at least quadrant 2, if not oftentimes quadrant 3. And I'm a fan. I love having big quadrant 3s. Who are the customers that are doing a little bit with us that could do a whole lot more?
Yeah.
Right. Because it's a lot easier to sell to somebody that's a customer than somebody who's not a customer.
It's true.
Right. And so when you start looking at that through that lens, it changes. I mean, I'm going to sound really old now. Most people aren't going to know what I'm talking about. It changes the horizontal and the vertical. But those are controls that used to be on the TV to cause the moving picture to be steady.
I was going to say, I need you to clarify that for the youngins.
So on the Blackline podcast yesterday, I talked about yellow pages come up, and Mike, my co-host, was looking at me strange. And he was, of course, looking at me strange. Why am I talking about the yellow pages? And I said, Mike, it was this, you know what Google is? Yellow pages was this big book. It was Google at the time.
Yeah.
So anyways.
So defining those quadrants, that helps you kind of know where you need to focus on and where your shortcomings might be as far as customer acquisition and revenue acquisition. Is that what you're saying?
No, actually what the opportunity quadrants really is it's looking at the world through the lens of revenue acquisition. It's actually not looking at the world through the lens of customer acquisition.
Okay. You know, you're right. Cause that's right. Cause high growth versus low growth. Yep. That makes sense.
Right. And so again, like, I mean, my entire market of people that aren't buying from me, that should buy from me, they're quadrant 3 accounts.
Right.
They're low value because they produce nothing for us right now. But we have some customers that are on smaller projects, and we know they could and should be doing more. Well, would you rather have a universe filled with the people who don't know who you are and can do a lot with you, or the people who are doing a little with you that could do a lot with you. So in my customer acquisition, like I don't mind bringing in small accounts if they fit large potential opportunities, because filling up I'd rather have my quadrant 3 bandwidth filled with customers doing a little bit of revenue with us in an effort to grow, right? What most people are trying to do is get everybody right into quadrant 1.
Yeah.
High value, no growth. We've got it all.
This goes to the one account and 1 million, or 10 accounts at 100,000.
Well, or they let whatever that first transaction is define what the total value is, and that could be on either part. Too often in that idea of, hey, we're going to land them and expand them, is we position ourselves as small and transactional. And like, well, no, I want to win this business. I want to, so I'm going to price it low, and we're going to handle this really small thing that's not worth it, because then they'll see what we'll do. Except then they go, oh, those are the people who handle. I mean, again, that's how Bessemer Trust and all these other high net worth, destroyed Merrill Lynch. Is they said, no, they're not. You don't want to work with them because that's not what they do, right? And so that's that place of, where your positioning is, and realizing that customer acquisition, it's kind of like what we talk about with leads, right? We always say qualify the company, don't qualify the lead.
Right. Yeah.
Right. But most people really aren't in a clear enough position. Like the number one weakness that I have seen across the board is, and it's the thing that makes me sad every day. It honestly, it's amazing that I'm able to get up in the morning, Jess.
Shocking.
Is just how little companies understand about their customers. It blows me away.
Yeah, I actually had that written down as one of my big takeaways, is having the ideal client profile really indicates the revenue potential of your customers. And I think that's a piece that the vast majority are missing.
But here's the bullshit of ideal client profile, because I've seen it. I even had to answer this. I got the answer wrong in a certification test, because they gave the ideal client profile, and they said, is this sufficient? And I said, no, it's not sufficient. It's true or false. Is this sufficient? I said false. And it turns out the answer was true. And if you look at it through the lens of who should we be selling to? Okay. Yeah, it was true. But that's not an ideal client profile. At best, it's a target market profile. At best, and again, I don't even think it's that. And by the way, in this same thing, it says ideal client profile is demographic only. Buyer personas gets into, the mindset and other attributes. And I'm like, whoa, hold on a mother blanking second. If your ideal client profile isn't demographic and psychographic, and if you're going to tell me that companies don't have psychographics, you're nuts. What's their growth profile? What's the economic conditions? Where's, like all those things help me understand the world of the customer. Actually, the client that I got off just before here said, well, the reason that we talked to you was that somebody had told you about us, and they'd seen you at Inbound. And then I had gone to your website a few times, and I was reading your material, and he talked about, bad plumbing is where he got the term bad plumbing. And he said, and I was reading it, and I'm like, yes, that's our problem. And he goes, and I'm thinking to myself, how can you know our problem this well? And that's why I wanted to talk to you.
Yeah.
Right. And I go, right, that's exactly how it's supposed to work. And I was telling him that's why we want our early sales efforts. Like, why are we just going for the appointment? Let's get him to the website.
Yeah.
Right? And we're able to do that because, like, we obsess about, we spend more time thinking about the problems that our customers have than we think about our solutions. And so, that understanding enables us to see, people ask me, what size companies do you work with? And I go, well, I'm going to answer the question, but it doesn't mean much. By the way, if you go back years ago, I used to define the size of a company by gross profit.
Okay.
Right. And I said, I don't care what their revenue is. I care what their revenue after direct costs are.
Right.
Because if I'm selling $100 million and I've got a 10% gross margin, I'm a $10 million company. And you know what? That professional services company that has 100% margin that does 10 million has, and people, I know you can't look at it that way. That's not the same thing. Like, no, it. But now, like, we judge the size of a company by the number of salespeople.
Yeah.
Right. Because the number of salespeople tells us what type of problems do you have. if you tell me you have one salesperson, by the way, with some segments about what market you're in, what you're selling.
Sure.
But if you have one salesperson, if you have no salespeople, I know one, you've got one set of problems. If you have one or two, you got another set. If you got 5 to 10, you're a different place.
Different.
If you're at 25, if you're at 50, if you're at 100, if you're at 250, I could go all the way up. But it also means, what's the solution side? We know if you have 50 salespeople, then we're going to be able, right? If you have, it lets us know what the expectations are. Like all those things come in just from that number. If I know, if I know some demographic data and number of salespeople,
Sure.
I can tell you your story, right? And I also know what my story is and where we should be thinking and what we should be thinking, et cetera. And the fact that that's just not commonplace. I'm like, what's more important to know than your customer base? Right. And when you, and you know what I think because I look at it as customer acquisition and revenue acquisition as two different things, I think it causes me to do that more. I mean, I think that's just, it puts me in a framework that we do go deeper because of that.
I agree. All right, cool. So kind of my biggest takeaway is they are definitely two different things, two distinct pieces that you really need to have strategies for and plan for and focus on both, not just focus on one. We hit the ideal client profile piece, which I didn't think we would go to ideal client profile on this episode. So that's kind of interesting how that feeds into talking about acquisition strategy and those pieces. And then, I really liked what you said where you were talking about the life cycle of a customer, or I'm sorry, life cycle of your company, and making sure that you have a reset. Because I think that's something that gets lost a lot of times, that when you've changed your life cycle as an organization, when you've changed your customer base, when you've grown, you've got to have a reset and relook at those metrics and those strategies as you're moving forward.
Yeah, I think if you have an ideal client profile and you don't have a revenue model attached to that ideal client profile, then you don't have an ideal client profile.
Doug, hot take.
One of the, a business owner that I know that, I mean, I have tremendous respect for him. There's a lot that he does that I don't really fully understand him. But one thing that he gets, and he was telling me, he said, Doug, it takes me 3 to 5 years to develop a customer. So I don't look at first year revenue. I don't care about first year revenue, right? Because I'm willing to spend money to get a customer because it's going to take me 5 years. Whereas most people are saying, okay, I implemented my customer acquisition strategy. Okay, well, where's the revenue?
Yep.
Like, by the way, why do people raise money? They raise money because they're going to spend $10 million to acquire $2 million of revenue, but they're going to acquire a customer base, right? Why is recurring revenue valued so much more? Because it creates a perpetual nature to the revenue acquisition side of things, right? That's why that pushes there. But again, if you don't, like, if you're jumping to recurring because everyone said, oh, you should go to recurring, and you don't understand that is literally a separation of customer acquisition, revenue acquisition, and then you 3 years later you go, I don't understand why this isn't working.
And on that note,
that is today's episode. All right, Jess, well, I'm glad we're successful today because you were smiling at the beginning of the episode.
And I'm smiling at the end. You're gonna kill it. You're gonna kill it with your soundboard.
What do I want to do? What do I want to do? Here we go.
First rule of Fight Club is you do not talk about Fight Club.
There we go.
All right, Jess, talk to you next time.
Bye.
And that's a wrap on this episode of the RevOps Show. Just to be clear, as Jess mentioned, the biggest takeaway is that customer and revenue acquisition are two completely different things. And if you disagree, we would love to hear your take. If you enjoyed this episode, please make sure to go subscribe on Spotify and Apple Podcasts, leave us a review, and share the episode. If you have any questions you would like to ask Doug or Jess about customer versus revenue acquisition, share a different take on the topic, or ask about anything else RevOps related, email me at hannah@imaginellc.com or hit us up on Twitter @DemandCreator. Until next time, remember, can't solve your upstream problems downstream.